What if I told you that Japan, a country with just 2% of the world's population, has the potential to disrupt the entire global economy? Recently, Japan's government released economic data for the first quarter of the year, and the numbers weren't good. The economy has shrunk. On top of that, Japan's top 3 auto manufacturers reported disappointing earnings for the last business quarter, warning that tough times may be ahead. Meanwhile, rice prices remain stubbornly high, making it harder for families to afford basic groceries and for retailers to stock shelves at reasonable prices. The government has tried to fix the problem, but with limited success. Now, you probably don't think much about Japan's economy, and you wouldn't be alone. It's on the other side of the world and doesn't make headlines like the US or China, but the truth is, Japan could hike interest rates in your country, crash global stock markets, and maybe even trigger the next worldwide recession. Why? Because Japan isn't just another country, it's one of the largest creditors on the planet. It holds over $1 trillion in US government debt and has long been a critical engine powering some of the riskiest bets in global finance, thanks to something called the yen carry trade. The yen is one of the world's most influential currencies, and it's getting stronger. That might sound like a good thing, but it's actually not. In 2024, when the yen surged, we saw exactly why. The yen carry trade began to unwind, triggering a rapid spike in the currency's value. Japanese stocks tanked, US equities and even Bitcoin felt the shockwaves. At the time, JP Morgan warned that the unwinding had only just begun. Fast forward to 2025 and that unwinding is still underway. Japanese government bonds are losing value, long-term interest rates are rising, and bond auctions are failing. The result? A slow-motion collapse of trillions in global leverage. And now investors are starting to panic. But this story isn't just about Japan, it's about the end of an era, the era of easy money. As investor Lynn Alden puts it, when global debt is sky high and demographic trends are this broken, there's only one real way out: currency devaluation. And as people begin to realize that, they start moving their money into scarce, decentralized assets, things that can't just be printed into existence. That brings us to today's video. Before we dive into the details, I want to touch on something often overlooked: demographics. Demographics show us who's working, who's spending, and who's retiring. If you don't have enough young people, you get a shrinking workforce, slower economic growth, and rising costs for healthcare and retirement. Japan is the oldest country in the world. Nearly 30% of its population is over 65. Its birth rate has been below replacement for decades, and by 2050, it's expected to lose about 20 million people, the equivalent of Florida's entire population. That aging crisis doesn't just impact retirement, it affects everything. Fewer workers mean less growth, more retirees mean more government spending. To keep the system running, Japan has had to borrow. A lot. Its debt to GDP ratio is now over 260%, the highest in the developed world. For years, Japan managed to pull it off. Interest rates were basically zero, and the Bank of Japan was buying up nearly half the bond market. Meanwhile, Japanese investors hungry for returns started buying US assets, especially treasuries. That's how Japan became the largest foreign holder of US government debt. But now in 2025, that balance is unraveling. The Bank of Japan is stepping back, and suddenly all that debt matters. Why should the rest of the world care? Because Japan has been the world's largest creditor nation, it holds over $3 trillion in net foreign assets and more than $1 trillion in US treasuries. Japanese investors also own American stocks, corporate bonds, and even real estate. In short, Japan's money has quietly supported asset prices and kept interest rates low all around the world. This was made possible by the yen carry trade. Here's how it works. Investors borrow cheap yen in Japan, where interest rates are super low, convert it into dollars or euros, and invest that money in higher yielding assets overseas, stocks, crypto, real estate, you name it. The difference between borrowing costs and returns becomes almost free profit. In 2023, while US interest rates were over 5%, Japan's were still negative. That created a massive incentive for this strategy. Bloomberg estimated hundreds of billions of dollars were riding on yen carry trades. But there's a catch. This only works if Japanese rates stay low and the yen stays weak. If either of those change, the trade starts to fall apart. In 2024, that's exactly what happened. The Bank of Japan raised rates for the first time in decades. The yen jumped 10% in a few weeks. Japan's market crashed. US stocks sold off. Bitcoin dropped. JP Morgan warned the unwinding was only halfway done. Now in 2025, it's still happening. Japanese bond yields are rising. The yen is strengthening. Trillions in leverage are at risk. Again, and here's the really dangerous part, Japan might not just stop buying US treasuries, it might start selling them. Japan's 30-year bond yield recently hit 3%, and the 40-year bond is at 3.6%, an all-time high. These bonds were supposed to be the safest assets in the country, but now investors are demanding higher interest just to hold them. Why? Because they're losing faith. Japan's debt burden is too big. The central bank can't keep buying everything forever. Bond auctions are failing. And without artificial demand, the market is discovering what these bonds are really worth. And it's not great. And that's where things get even more interesting. Some investors are turning to Bitcoin as a hedge. One company in Japan, Metaplanet, owns thousands of Bitcoin. Recently, its stock surged as investors looked for safety outside traditional government assets. We even saw a short squeeze on Bitcoin-related trades as fear spread. This isn't just about crypto, it's about trust. When government bonds, supposed to be the most stable financial instruments, start acting like tech stocks, people start to question the whole system. So what's next for Japan? The government has two choices, and neither is great. 1. Raise interest rates to fight inflation and protect the yen, but that would blow up the national budget. 2. Keep rates low to manage debt, but let the yen fall, making imports more expensive and raising the cost of living. And here's the kicker. The Bank of Japan already owns over 50% of the bond market. They've been printing money for years, but now that's not working either. Investors are walking away. Interest rates are climbing. Japan is asking the question no government wants to face. How much longer can we pretend this is sustainable? Because when an economy is built on cheap money, even a small rate hike can cause it to crumble. Meanwhile, Bitcoin quietly hit an all-time high. And no one really noticed. Google search interest is still low, but something's shifting. The world is starting to realize that maybe this entire debt-based system isn't sustainable. Maybe the Bitcoiners were right all along, and Japan is just the beginning. The US isn't far behind. Governments can't grow out of this. They won't cut spending. They won't raise taxes fast enough, and they can't default. So what's left? Currency devaluation, credit downgrades, pretending everything's okay. As Lynn Olin said, nothing stops this train. And if that's the direction we're heading, it makes sense why more people are turning to assets outside the system, like Bitcoin. It can't be printed, it doesn't care about central banks, and it's immune to manipulation. That's why I've been dollar cost averaging into Bitcoin. I still hold stocks, because if I'm wrong, I want a plan that still works. But this story, it makes a lot of sense to me, and I'm watching it closely. Let me know what you think in the comments, smash the like button, subscribe if you haven't, and I'll see you in the next one.